The World Bank has highlighted that Kenya's economic growth has been robust despite global slowdown and low commodity prices. This has been supported by non-dependence on oil exports and price stability of top exports such as coffee, tea and horticulture. Take a look. The most recent World Bank Group economic update for Kenya has highlighted positive economic performance supported by low oil prices, good agriculture performance, supportive monetary policy and ongoing investment in infrastructure.
I think the traditional things were really drove the economy, that's tea and coffee. But also at the same time we had a lot of capital investment towards the railway line, the SGR, and as well as capital investments coming into the oil and gas exploration sector. So I think these are the things that really pushed the economy forward and created quite a number of opportunities for the population as a whole. And I think that going forward, these are probably the strengths that we should be concentrating on, and also begin to add value to the processes that come into those sectors, so that we are able to really have like an entire value chain of product from farm to fork, for let's say for tea and coffee processing and also for oil exploration as well. I think one of the key things that has really come out is that for countries that are not heavily reliant on oil exports, we've seen a lot of the energy costs come down. So fuel is cheaper, producing electricity is cheaper for quite a number of countries as well. Inflation has come down slightly for most of the countries that we've seen in Africa. And because of that, we've also seen the cost of production also come down. So I think even based on that, people are able to buy a significant more quantity of goods than they were before. So they have a much larger portion of their income dedicated towards the purchase of goods. And this has also uplifted a lot of the demand that these companies had not previously seen before.
This is in comparison to most sub-Saharan economies that recorded modest and lackluster growth in 2015.
Growth in 2015 is now going to be averaging around 3%, which is down from 4.5% last year, and this is the lowest since 2009, the year after the real estate bubble burst in the US. So this is a rather grim projection. For 2016, growth will be around 3.3%, and we expect, however, a slight rebound in 2017-18 to around 4.5%.
Commodities such as oil, metals and ore contribute 60% of exports revenue in sub-Saharan Africa. As a result, oil exporting countries had to bear the full brunt of plummeting prices at the global market, sinking to as low as $28 per barrel.
What is expected over the next 3 to 5 years, I guess, is that the oil price may be fluctuating and maybe inching up to between $50 or $55 per barrel, but that remains to be seen. Of course, having lower prices for quite a while may affect spending decisions, and we're already observing that with major oil companies. Lower oil prices are affecting not only their investment in terms of exploration, but also there is research at the bank that was published last January that lower oil prices tend to increase the time to exploit.
At the moment, we are seeing quite a number of the heavily traded commodities like copper and gold, diamonds as well, tea and coffee, a lot of the countries in Africa tend to trade in. Primarily, we are seeing the prices coming down or remain subdued in the last 1 or 2 years. And this is actually expected to continue going forward even for the next 3 to 5 years based on the global market trends. And also at the same time, because of China being heavily reliant on a lot of the African goods, we are seeing this now having a shock on African economies as well. So because China growth is slowing and not expected to sort of increase in the next 2 to 5 years, we're also seeing a lot of the African economies sort of now have a domino effect in them as well.
Kenya, among other East African economies, maintained robust economic growth in 2015, mainly because its major exports are from the agricultural sector, whose prices remained fairly stable. But with a forecast of continuous drop in commodity prices, Kenya may need to look into other sources of export revenue to protect itself from monetary and fiscal shocks.
The shock that the region has sustained in terms of the drop in commodity prices, especially oil, but also other commodities, needs to be seen as a shock that is likely to persist for some time. So commodities prices are expected to be low and volatile for longer than in the past. And countries need to address the economic vulnerabilities and search for new sources of sustainable and inclusive growth.
The World Bank recommends that Kenya reduces her dependence on agriculture, which contributes over 25% to the GDP. Among the proposals is strengthening domestic resource mobilization.
For most countries in the region, there's also need to strengthen domestic resource mobilization. The extent of taxes that are collected in the region is quite low, and it's important to increase the tax contribution of the non-resource sector and to widen the tax base, as well as to strengthen tax administration and streamline taxes.
The World Bank reports that the subdued growth in sub-Saharan Africa should not overshadow opportunities in efficiency of infrastructure investment, energy sector reforms, a more inclusive financial sector, and improvement of the business climate.
We need to take this moment, we need to take a pause and actually, look at this particular time as a moment of challenge. And it's a serious challenge to our economies on the fiscal side, on the monetary side, as some currencies have seriously depreciated, as a challenge on the balance of payment side. But it's also a time of opportunity. It's the opportunity to actually do the right reform. It's the opportunity to make sure we address the macro imbalances that are created by these headwinds.